Hi, Ron LeGrand here. Before we get started with the podcast, I thought you might want to know that I recently recorded a 90-minute online training about how we make so much money today in the terms business. That's on pretty houses in pretty neighborhoods, not the junk houses that we have to go rehab or wholesale. I go through step by step on exactly what I and thousands of my students are doing right now to make the fastest and the easiest money in real estate without using your money or credit. If you're interested in doing just that, go to thementorpodcast.com/free training. See you there.
Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody. Welcome to another edition of the mentorpodcast.com. We have with us Joe Viery today, who has promised that he was going to cut my income taxes in half and show you how to do the same thing. Is that right, Joe?
That's exactly right. I'm going to reduce or eliminate your taxes.
All right. Well, I can tell you right now, I pay way more than I should be paying, in my opinion. So I am very anxious to learn about any way to keep from paying the IRS money every single year. Now, I can tell you guys listening right now that a lot of you are not going to be able to use what Joe talks about today. Even if you don't do it now, you're going to maybe have a time in the future when you will. But who knows? You might even have some tips that apply to everybody listening. So, Joe, I don't know anybody that knows any more about you than you. So why don't you tell us who you are and what you do? And I'm going to turn you loose and jump
Great.
in.
Love to. I've always been in the entrepreneurial mode. I started a business when I was in college, and I operated that business. It was in a different, I graduated with a business management degree and owned a travel company for 20 years. And then I started working, when I sold the business, I started working with the California Association of Realtors. And I was helping members of, realtors with financial planning. I was securities licensed, insurance licensed. And this concept came to me. I had a gentleman who kept wanting to talk about this new thing he wanted me to share with me. And I kept blowing him off because I thought he was going to sell me Amway. So about a year later, I finally said, okay, Mike, let's go. Let's have lunch. He told me about a concept called cost segregation. I had two clients that were looking at writing a check to the IRS for over $50,000. And I was able to have them keep that money in their bank account. And then this was in 2007 and 2008. And everybody knows what happened. The car went over the cliff. And basically the California Association of Realtors completely dried up. The membership went down less than half. And the gentleman who owned the company that I placed my business with said, hey, you're really good at this. Why don't you switch gears and come work for me and be in the cost segregation industry? So I've been doing this since 2007, 2008. And my clients are small single family homes in Alabama that were, for purchase for like $20,000. I think that's my lowest, all the way up to a $500 million building in downtown San Francisco at Union Square, which was the old Macy's men's building. So I've kind of seen it all, and we've kind of evolved, and we can help anyone who owns investment real estate with reducing or eliminating their income taxes.
Okay, so let's start by you explaining to everyone what cost segregation is in layman's terms.
Perfect. So what cost segregation is there's a concept in accounting called depreciation. And what the IRS is allowing building owners to do is theoretically saying, okay, as I'm owning this building, I'm using it up. So they give you an expense. For residential, the expense is divided by 27 and a half years. Now, where Congress came up with 27 and a half years, Google it. I don't know. For commercial build, Ron, maybe you know.
I don't have any idea. I don't have any idea where Congress comes up with most of the stuff they come up with.
I think they had a dartboard and they just had all these numbers and the dart hit 27 and a half. So they came up with 27 and a half. For commercial buildings, hotels, senior centers, it's 39 years. So you're getting a real small expense. And what do expenses due to your taxable income. They reduce it. The more expenses you have, which is one of the values of investing in real estate, the less taxable income you have. So bottom line is what we're doing, and this is, I think, the easiest way to explain it. When I tell a client to look down and look at the floor and they see carpet, and I say, okay, now that carpet is either 27 and a half or 39 years, according to the IRS. Do you think your carpet's going to last 27 and a half or 39 years? And they say, are you crazy? I'll be lucky if it lasts 3 years. And so bottom line is the IRS has admitted and has guaranteed there's hundreds and hundreds of components of the building with shorter lives than 27 and a half and 39 years. And so what we do as engineers is we find all of those components in the building. And if you put it in a blender on low, you get accelerated depreciation. And what we're giving you is we're giving you the depreciation today that you would get over 27 and a half years. And that's a big number and it's a powerful number.
For example, you're going to come in and put a value on my central heat and air conditioning system because it certainly ain't going to last 27 and a half years. And then you have, I imagine you have a chart that tells you how many years we can write that off. Like, what is it, 5?
Well, the HVAC is a little bit different, but just think of it this way. For the interior of the building, meaning, and I'll go through the litany. It's a small list: flooring, cabinets, countertops, window coverings, accent lighting are all considered personal property, and those fall into the 5-year bucket. Okay. Outside the property is 15-year. It's called land improvements, and these are going to be fences, pools, patios, landscaping, outside lighting. And so if you combine, and then there's another category called 7-year property, which is really a very small, it's like a generator, an emergency generator is 7-year property. And then furnitures and fixtures are 7-year property. So if you combine the 5, 7, and 15, what we're giving you is we're accelerating your depreciation expense so you get it today, and instead of waiting that 27 and a half years.
Now, none of this applies to our personal residence. Is that
no?
True? Okay.
It's only investment real estate. Personal residence, it's a non-depreciable asset.
Okay. So your job is to come in, write down all the pieces, decide how many years those pieces can be depreciated based on government regulations, create a chart, get down to the bottom line to come up with a total number that we can write off a lot faster, therefore creating a much larger deduction. By the way, I just had this done to my office building last year. I don't know why it took me so long. I'm just coming from memory here. It seemed like we had about $150,000 worth of write-offs, which in my case is about $50,000 that did not go to the IRS because we had that done. So guys, you better pay attention here. You may not, this applies to just houses as well, no, because I don't know, somebody told me that it wouldn't work on houses. That must be false, huh?
Well, here's the situation. Since I've been doing this since 2007, bottom line is I grew up using the audit technique guidelines published by the IRS. Anybody can go and look at that document. I suggest if you want to sleep at night and you can't, read the IRS audit technique guidelines. It's a long document, but basically the IRS spells out, number 1, cost segregation is the correct way to do it. Number 2, here's how to do it. We followed their advice to the T. One of the methodologies is the one that I grew up on, which is the detailed engineering. That's where we send somebody to the property to document it, photograph it, measure all of the components. So you can't do that for a single family home. If I send my engineer to a property and to spend hours or days measuring everything, it's going to cost thousands of dollars. But if you have a single family home that has a basis of $500,000 or less, and you want to accelerate your depreciation expense, it didn't make sense. If you paid $3,000 to depreciate a single family home, it didn't work. So what we came up with about 6 years ago is we have another technique, which again is approved and authorized by the IRS. It's in the audit technique guidelines. It's called the modeling technology. And what we do is we do an analytical study. We take our experience, we take our tens of thousands of buildings throughout the years, and we will compile a report without going to the property and measuring everything. So it's a good news, bad news, meaning that is it like the full detailed report? No. For example, we're not counting linear feet of cabinets. So if you go and you throw a cabinet away, you can't use the modeling report for dispositions because we're not giving you linear feet of cabinets. We're just telling the IRS, this is how much 5-year property you would expect to find in this building, in this location. And basically we tell the IRS, this is the 15-year property. So you get the acceleration of the depreciation and obviously save a lot of money, and it's affordable. We do this study for hundreds of dollars, not thousands.
You can do it on single family houses.
Yes.
All right. Well, First of all, about what price range, about what value of a house do you think it would begin to make sense on?
You know what? Keep in mind one aspect. We're not land valuation experts. We give our clients our opinion, but we make them write to us, put in writing what they want to allocate to the land. So number one, you got to peel off the land. So let's do some simple math. Mm-hmm. Let's say you buy a building for a single family home for $120,000 and somebody allocates $20,000 to land. So I've got $100,000 to work with. And let's say I find 25%, which is about normal for a single family home. That means that I'm going to give the owner of the building $25,000 in additional depreciation expense above and beyond what they would have received if they did straight line.
Well, that's a big deal, of course, until you get ready to close out and sell that thing.
Oh, whoa. Let's back up a minute, though.
All right.
Here's a big caveat is that there's another situation. It's called depreciation recapture. The IRS is saying, hey, we're giving you all this wonderful expense of depreciation as you own the building. If you sell the building for cash, you've got to now pay some of that back. It's called depreciation recapture. Mm-hmm. But here's the thing that a lot of accountants and clients don't quite understand. And I think that this makes cost segregation even more powerful. Since we identify the 5 in the 15-year property, what our savvy accountants are telling the IRS if they sell a building for cash. So let's say that somebody bought a building 5 years ago. Now they sell the building. The idea is if you bought a laptop 5 years ago and you spend $2,000, what's the laptop worth? 50? 100?
Probably nothing.
Probably nothing. Yeah. So basically the savvy accountants are telling the IRS that the 5-year property of the building has almost zero residual value. The 15-year property, you've used up, 1/3 of that building. So that amount can be taken off the depreciation calculator. And basically you save money by doing cost segregation because we've identified the 5 and the 15-year property. And most accountants just don't get this until they talk to someone like me.
Well, that's very good information. That's worth our whole trip here today. I'm going to have to make the note on that one myself, make sure my accountant gets that. So can do a house. Again, where does it start to make sense? What value of the house do you think?
Okay. You know what? It's a moving target. And what we do is we don't charge for this. If you go to the website, you'll see an input form. It's www.ustagi.com. And basically, we don't charge. If we get the information on the property, which is really simple. Okay, what did you pay for it? And when did you place it in service, and the address of the building, and we perform an estimate. So what we do is we will look and see if it makes sense. We're going to see how much engineering time it's going to take to do the project. And then what I like to see is 10 times the amount of my fee. So if we charge somebody $500, I want them to save $5,000 in taxes. Mm-hmm. That's my opinion. They could do it if they save $2,000. And we've had some clients that just want to win and beat the IRS. I don't care, but I think, 10 times my fee is what it should be. So bottom line is this. I would say if you want me to throw out a number, probably a $50,000 total acquisition, building and land, because we're going to peel off about 20% for the land. So we're going to be down at 40,000, and I probably can make the numbers work.
How many clients you got to buy $50,000 houses today?
Well, you know what? I'm going back in time. I don't have hair. Yeah, so that I'm a little bit older. Okay. Not as, older than Ron probably, but I don't know exactly because he's so damn young looking. But bottom line is,
I got you. But so in other words, any price house.
Oh, I would say $50,000 it should be the benchmark. And you're right. Where the heck are you going to buy a house nowadays? Yeah. I go back 6 years when I actually did a building in Alabama for 20 grand. Not today.
I just did one with a student, and the closing costs were about $50,000.
Oh yeah, yeah. So I get it. I understand.
So obviously, the higher the price the real estate we own, whether it be residential or commercial, the more money we're going to save by letting you do your thing.
Yes.
And frankly, it's not complicated because all we do is hire you and answer your questions and forget about it. So what are the downsides here, and what are the rules? It seems to me like something. When I did mine, I owned one of my buildings for quite a long time, and explain the situation. Let's say I owned a building for 10 years before I call you. How does that affect my cost segregation?
That's great. It's a good question, because again, our accountants, we always laugh because our accounting team, they always say, well, it depends, and there's a lot of it depends. But bottom line is, if I do the math and do the numbers, my opinion is, and we'll run these numbers for everybody just to see. My opinion is we can go back about 15 years. Oh yeah. So if you've owned a property further back than 15 years, and I don't care how old the property is, age of the building has nothing to do with it. It's when it was acquired. That's when the depreciation clock starts again. So if George Washington slept in that building, I don't care. All I care about is when the new owner bought that building. So we feel that we can go back about 15 years. And what we do is we obviously have to take into account how much depreciation has already been taken during those 10 years. Right. We can't double dip. So we have to take that off and then see if it makes sense to continue with the acceleration. And I'll tell you, Ron, 9 times out of 10, the answer is yes, it will make sense. So 15 years is the benchmark.
So if you're watching this thing and you own any kind of real estate, especially commercial buildings, it makes no sense not to contact you unless they've already done the cost segregation. Like I said, I bought my building that I'm in 2003, and it was just last year I had it done. And then I bought another building a few years ago next door, and I had it done on that one as well. So that's the first thing I do. And now, of course, there are going to be some recapture when the property sells. So I think we probably got people thinking, well, I'm going to buy a house and I'm going to put a lease option tenant buyer in there. Well, what if they actually buy? Well, first of all, that's the odds that they won't are in your favor. But even if they do, it seems to me like it would be better to have that money in my pocket than now today, even if I had to pay some recapture on it and pay the IRS later. However, if you go to the Gold Club site, many of you are Gold Club members, there's a lesson on there called How to Never Pay Taxes When You Sell Real Estate. And I explained to you how you take one house and exchange it into 3 houses, and you buy them with owner financing, 4 times your asset value, 4 times your cash flow, and you get more money back than you actually put into the exchange when you sell the house. Gold Club. Go to the Gold Club under resources, and just put in the search box How to Never Pay Taxes, and that lesson will come down. So in other words, we're never going to pay taxes if we enlighten ourselves and learn the rules. And you and I both know that the IRS is a gorilla we do not want to dance with. They're the biggest collection agency in the world. And they have powers that nobody else has. And boy, they can screw up your life very, very fast. So we got to do things right and make sure that we know what's going to happen if the worst happens at the time. I sell a property and I got to pay taxes, but because we're going to sell everything sooner or later. So, all right. So what other downsides, Joe? Rules, for example, that are not widely known that might trip us up?
I'm glad that that you mentioned that. And this is going to sound maybe trite or maybe whatever. There aren't very many downsides to doing cost segregation. The one downside would be the fee. You got to make sure, if you're finding somebody that the fee will fit into your financial planning. Mm-hmm. You want to find somebody who I believe uses the audit technique guidelines as their mantra. I have been doing this for so long. I've seen all kinds of jokers out there that really don't even know how to spell audit technique guidelines, and they have never seen it or never read it. I think that's important because we defend our work. That's what you're paying when you come with U.S. Tax Advisors Group. We will defend our work. And again, I hate to say this, but I have never lost any questions by the IRS. I've never been in an audit, but I've been questioned because the agent will ask me, well, how did you calculate this? I get the engineer on the phone with the IRS agent and we defend our work. And as soon as they get the answer, they say, have a good day. Thank you. And that's it for us.
Okay.
So those are the two big things. Make sure that you find somebody who knows what they're doing and can do the job that will withstand any IRS questioning. Because as everybody knows, with the political climate, who knows what's going to happen with the IRS and their powers.
Yep. Well, Joe, what state are you in?
I'm in California, but I have my right-hand man is in Tampa.
Okay.
And we have people all over the United States. We're a nationwide company.
Okay. Well, how do we reach you again?
Go to the website, www.ustagi, and that stands for U.S. Tax Advisors Group Incorporated. So ustagi.com, and go to the website. We've got our input forms. Fill out the form, and we'll respond back with an estimate and a fee on your project. All
right. Just that simple, huh?
That simple.
So no risk and no investment till you get an estimate, and then you just sit back and relax and sign your agreement and wait till you get a report back.
Yeah. That's it. Great.
Okay. And then send it to your accountant, and then probably want to have a discussion about.
And we stand by our product all the way. So in other words, when you do a look back study, there is a document that you have to fill out called a change of accounting method form 3115. And just think about it. It's simple. You're telling the IRS, okay, I used straight line for 10 years. Now I'm going to switch over to accelerated depreciation. Here's the difference in all the numbers, acceleration less how much I paid. We do the heavy lifting. We cannot sign tax returns, so we're not going to fill out the 3115, but we're going to do the calculations for the accountant, which is the hard part, and then we're going to be able to help them fill out the form, which we know how to fill out the form, so we can help them. So bottom line is, we're with you the 100% of the way. If your accountant has any questions and wants to ask me to get on the phone with them or my accounting team on the phone with them, we definitely will.
So then you just make sure that your accountant their accountant gets in touch with you to make sure they don't miss anything and or misreport. And guys, I'm telling you right now, the more you know, the more mistakes you can help keep others from making. And just because they have initials after their name doesn't mean they know everything about even that which they're doing. It's always a good idea to check your accountant's work. I'm not going to get any deeper in that, but I'm talking from personal experience here. All right. Well, Joe, I'm out of questions for you unless you got some, what should I have asked you that I forgot to ask you?
Well, you know what? You did a good job. So I think that for now, we can end. The one last thing I'm just going to mention is we're an engineering company. There's another engineering study, which I'm not going to get into detail, but basically they're the energy studies. And a lot of my clients are value add clients where they buy a single family home, they go in and they tear out all of the appliances, the lighting, the put new windows, new roofs, new HVAC. And basically, if you qualify, and it takes an engineer to do the testing, you can get a $2,000 tax credit per door. This is not a $2,000 depreciation expense. This is a tax credit. That's powerful. That's like a check for $2,000 from the IRS. So if you have multiple properties, like we can't do it for one, but if you have 5 properties that you've done this for, let's say last year, we can do an energy study. And I would hope that if you really are being asked to write a check to the IRS, to use all the strategies out there, because some of them are really powerful.
Can I go back if I think I paid too much? 3 years?
3 years.
So literally, we can fix our tax returns that are up to 3 years old by doing cost segregation. So if I do cost segregation now, are you saying I can actually go back and recapture?
Yes. And here's the deal. You can actually go back and get a refund. And there's the paperwork to do this. So let's say I find a whole bunch of depreciation and you paid taxes 2 years ago. You can use that depreciation to get a refund of the taxes you paid 2 years ago.
Well, that's very, very important. Okay. All right. Well, man, what an enlightening interview. So let me give you a web. You are at USTAGI.com, and you are Joe Viery, Viery, right?
Yes, sir.
Okay. All right. So if you guys want to learn how to actually acquire some real estate so you can do cost segregation on it, whether it be residential or commercial, go to my terms training at ronlegrand.com/terms and watch a webinar I did teaching you step by step how we go buy pretty houses, higher priced houses preferably, because I've learned that the higher priced house you buy, the more depreciation you get. I mean, it just came to me. And in all of my teaching, Joe, it surprises me how many people have no idea the value of depreciation on this real estate they're buying. They don't realize that. I mean, I guess because they come from jobs or somewhere else, wherever, and they, get a paycheck and they don't think about these kind of things. But boy, when you're paying the kind of money that I'm paying to the IRS, you want every tax advantage you can get. And depreciation is, of course, one of the biggest and easiest to get. But the higher priced properties you buy, the more depreciation you get, the less taxes you pay. So if you guys want to learn how to buy some really nice houses, $1 million houses, $1.5 million houses, or whatever, as well as the lower priced ones on terms, without using your credit for sure, and usually none or little of your money. In other words, yes, you can acquire $1 million house with a $10,000 or $15,000 down payment, and you'll be surprised how many of my students get them with nothing down because of the scripts that we've created over the years, which doesn't make any difference to your depreciation. You go pay cash, or you buy it with nothing down with owner financing, your depreciation is the same. And imagine what kind of cost segregation we can get out of $1 million house.
Yep.
Did I hear you say that it averages about 20% of the value of the house?
25.
25%. Holy moly.
Yeah.
That's a $250,000 tax write-off.
And you don't have to use it this year. If you don't need it, it carries forward forever. It's probably 15 years, but no one, that's forever.
No kidding.
So it carries forward. So if you don't need all the 250, you only need 200, you'll get 50,000 the next year. If it's a net operating loss.
Boy. So it pays us to understand this cost segregation stuff. Take a little time and dig into it and be prepared, because most people don't have a clue about it. I mean, is that your experience, the public ignorance about this thing?
Well, here's the one sad thing. And I basically work very, very well with accountants. Mm-hmm. But I will tell you that even accountants have a very difficult time with depreciation. And I will defend them a little bit because they're busy filing tax returns. A lot of them aren't looking for ways to, for everything they can possibly do. No offense to them. But bottom line is, if you can go to your accountant and say, hey, what about this accelerated depreciation, Mr. Accountant? Will it work for me? Bring it up, because even if they've never mentioned it to you, it's a possibility that it's because they just really don't understand how it works. And by the way, they can't do it because obviously they don't know construction. So they can't look at a set of plans and figure out the components in the building that'll qualify for accelerated depreciation. So bottom line is they can't do it. So a lot of times they just don't even mention it.
And you just made a very valid point. Again, you guys cannot rely on your CPA to think of everything there is to do to lower your taxes. That is not how they're programmed. Some of them will give you suggestions, but most of them are just going to file your tax returns. So again, the more you know what to question, and the more people you know, like Joe, to put your CPA with, the better you're going to come out. And okay, some of you are listening, I don't pay that much taxes, I don't care. But hey, you're on Planet Ron, so you make so much money, you need to worry about paying taxes. Besides, I can't support this whole government by myself. I'm going to need your help. So get out there and make more money, and then you can pay more taxes, and then you'll learn how to save more taxes. And I promise you, the more you make, the more time you're going to spend on saving the taxes. Go writing those big checks. All right, well, Joe, if you've got nothing left to say, or no big brilliant advice you want to offer, and we're going to end this thing.
All right, Ron, it was powerful. Thank you for having me.
I'm telling you right now, I'm going to make sure our people get this, because it's very important to everybody watching this podcast today. So thank you, Joe. And I wouldn't be surprised if we don't do this again sometime in the near future.
Would love to. Thanks, Ron.
All right. Thank you.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.